Yeah, with the bulk of the hold period being through COVID, that's what people need to realize is, the world shuts down, everything gets closed, everybody's sitting in their homes, racking up those electricity bills and everything. And here I am through COVID, which was the bulk of the hold period of this deal. And we did so well. So remember that about real estate. If you're 100% into the stock market, which is what I used to be, I've done 25 years of investing in the stock market and I still put money there. You have so little control, so there could be a Ukraine war, some policy change. And, even if the company performs well, your stock price could go down because it didn't meet an analyst's expectations. So diversify. If you keep going into different sectors, but it's all still in the stock market, that's not diversification.
Hey everybody, this is the Yield Coach Show, Season 1, Episode 29. I'm your host, Ian Brown. Every episode we bring you dynamic entrepreneurs, real estate investors, business leaders, and inspirational guests ready to open up, share their story, the good, the bad, the ugly, so you can learn lessons, gain advantages, and accelerate your success. Quick housekeeping items. We are open to outside investors. We'll have offerings by early next year. Go to yield-coach.com if you want to jump on our portal and join our investor list. We also have our Employee to Entrepreneur video course. Scroll around, you'll find it. It's a great introductory course for those that want to be active investors. All right, very excited about our guest today. We have Sandhya Seshadri, and she's a heavy hitter. I'm lucky to have her, and we're going to have a little fun today. Some background on Sandhya. She has invested as a limited partner and a key principal and a general partner in over 3,000 multifamily units. She has over $200 million in assets under management in the United States. She was in equity markets for 20 years and moved to commercial real estate for tax advantages. She is actively investing in the Dallas-Fort Worth multifamily market. She's in multiple mastermind groups. She has a bachelor's and a master's in electrical engineering and an MBA. Very excited to talk about apartments, forced appreciation, all kinds of advantages that we have in this sector. Sandhya, welcome to the show.
Thank you so much, Ian, for having me on your show. It's such an honor to be here, and I'm excited to continue our conversation.
Oh, certainly. Let's just start with a little bit of background. Let's tell us about yourself. Obviously, you have a great education resume, and how you ended up as this hustling apartment investor.
So I was in engineering in a very technical role at a Fortune 500 company and realized very quickly that it's the business types of folks who make all the decisions there. And I wanted to understand how they did that. So my company was kind enough to send me part-time for an MBA. And that's where I got all my financial knowledge, got into the stock market through investor clubs, people I met in my MBA course. But I realized that I was making a decent amount of money, and so was my husband with his W-2, and we wanted something to give us a little tax advantage. And I stayed away from single family because I just don't have a handy person background to go fix a leaky toilet on Thanksgiving or Christmas. And, the whole tenants, toilets, trash, and termites didn't sound very appealing. And when I did a financial analysis, the margins were kind of low as far as the cash flow. And that's why I stayed away from single family. But when I heard about multifamily and how you have the economies of scale to afford to have a third-party property management company doing all the day-to-day work for you, you have a maintenance person on site, you can afford full-time property management, leasing staff, etc. They take care of all of those hassles, and I'm more of an asset manager looking at KPIs, making the business plan, more strategic decisions while they take care of the more day-to-day tactical work. And that made it a lot of sense. So I jumped into it with a mentoring program. I invested passively to start with, and then I met people with whom I partnered to find my first deal.
That's a wonderful story. So was it scary to jump from, you have a great background as an engineer, MBA. It sounds like your husband was also making good money. Now, I assume you're a full-time investor now, correct?
Yes, I'm a full-time investor. I was full-time actually in the stock market also for a while. From my engineering job, I went full-time into the stock market when I had children. And then, a couple of hours a day of trading was plenty for, a stay-at-home mom, with a simple life in Texas. We keep our cars for 10 years kind of stuff. We're not into private planes and all that crazy stuff that a lot of people are into. So, we lived well within our means, and one job, was plenty for us and what I made from the stock market. But the stock market returns started getting better and better. The market did really well. And that's why I was looking for a tax advantage through real estate.
I wasn't planning on going down that little rabbit hole, but I think it'd be good for the investors to maybe hear just high level some of the tax advantages and some of the reasons you went from this kind of earned income to passive income on the tax side. Do you mind speaking to that just high level?
Sure. Since I did not have a full-time W-2 job, the most important thing was for me to talk to my accountant and see how I qualified. And so they talk about a qualified real estate professional. And if you have at least 750 hours of active real estate work, then you qualify. And then you can take all the tax advantage, the depreciation that you can learn about, that you can completely apply all 100% of it against not just what you earn, but also against potentially a spouse's W-2 if you are a qualified real estate professional. And that's when it made sense for us. So we had our conversation with the accountant, figured out what we have to do the following year for me to qualify, make sure I was involved in active asset management activities in addition to my passive income. And then we had the benefits that justified it.
And I think you just said it, but it was all through the asset management and operations side. You weren't doing any like third-party brokerage or things like that, right?
No, I was not.
Okay. Yeah.
Not a realtor. I'm not licensed in any way. All I do is asset manage properties.
Yeah, that's A-okay. I am a broker in Florida, and sometimes it's a distraction. Sometimes it's beneficial because you can pad your equity with your own fees. Okay. Well, it's a little harder to do in large transactions, but if you're just doing like a one-off solo investment, say you want to buy like a quad by your house and just like a little legacy deal, you could probably write in 6%. You could probably write in some seller credits. You might be able to make like a 20% down deal feel more like a 12%, 10% down deal. So I like that. But in the big deals, you know how it is. The big brokerage houses, they don't want to share anyways. They're like, oh, we're not offering buyers fees. Or if they are, they're like a point. I've been offered like a quarter point one time. I'm like, are we having this conversation? So I think it has a little less advantage in the big boy world to kind of see maybe as a competitor, where on the small stuff, I feel like I have a fighting competitive advantage on the small stuff. But okay, so tell us you've been in Texas a long time. Is that why you picked the Dallas Fort Worth market? I mean, kind of tell us how you came into multifamily. I heard a Mastermind in your story, and then of course, how you honed in on the Dallas Fort Worth multifamily market.
So I've lived here for over 32 years in Dallas. So, places that were empty fields where I might have practiced driving and stuff are now like huge cities by themselves. So you can see all the economic growth, the diversity of jobs, et cetera, that's happening in Dallas. And every week I read in the news that one more company is moving its headquarters here. So it made a lot of sense. This was a great market. So I picked a mentoring program also. It's Brad Sumrock's that is based here, that a lot of people, I can meet about 500 plus people who are all operating deals in Dallas. So then I have, firsthand knowledge from active operators doing business here. And that's what I was looking for. That's why I joined that program. And that's where I found my partners.
For those that are considering a mastermind, I think it's a little intimidating for some people and maybe some of this audience. What are your thoughts on masterminds? And obviously they were good for you. What do you think some of the biggest benefits are to joining a mastermind?
I think it collapses timeframes. So it helps you get your first deal faster. I don't think I would have met the right people with whom I could take down a, almost $7 million property for my first deal without having experienced people partnering with me. And they only partnered with me and I only met them because of being in a mastermind. So the network is a big deal. It makes you go, it's the who, not how concept. You can get there faster. The minute I tell brokers in the Dallas area, right from the beginning, even before I had my first deal, that I was part of his group, I got so much respect. Brokers take me seriously. I get all kinds of help because you leverage the resumes of the more experienced people when you're a newbie. So it helps you get there faster. For me, the other thing was when you do a large syndication, like $7 million was my first deal, it was 86 doors. You need to raise money from other people. And so if you've never done that before, you can leverage the resume of your experienced partners and the network you belong to, where you have your training, where you still have access to coaches, etc. So for me, the biggest benefit is it spurs you into action because you're probably going to pay a hefty fee for it. You're going to have a network of people to help you, and you can definitely make fewer mistakes because of it, because you'll have somebody with experience on your team. Multifamily is a team sport. It's not like buying a single family rental down the street from you and just renting it out and making mistakes as you go, because it only involves your money. This involves a whole bunch of people's money that I can't pay back on my own if there's mistakes made. So I think mistakes are costly. It ruins your reputation. And I think that's the benefit of being in a network of people. But the biggest thing I would say is if you're considering joining a mastermind is write out your goals very clearly and then talk to a few people who have been through that mastermind to see if those goals are realistic and achievable before you put down the money, right? It's just like if you're going to hire a contractor to do a major kitchen remodel, you're going to talk to other people who referred the same contractor to you who've done the kind of remodel that you want to do, right? It's the same concept.
Yeah, I totally agree. And, obviously we're both participating in masterminds right now. And, that the financial barrier to entry was a turnoff for me. Like a lot of people, I was like, oh my God, I could do so much. I could send so many, my open letter marketing, I could hire 5 VAs, all the things I could do with the money that's going to the mastermind. But then you kind of go through that looking glass, through the veil, and you're with people that have also committed, that are also taking it seriously. And it is a high barrier to entry, but you're right. I mean, if you put the time into these masterminds, it could save you a whole lifetime. It could save you 10, 20 years. It could save you you could do the work of 3 careers because, you went into a mastermind. That's wonderful. So I was going to ask you something else that came up there. Oh, can we jump into, so you go into your, I think it was the Brad Sumrock one was the one you mentioned. So I kind of put you into multifamily. Can we jump? I mean, I want to kind of jump right into one of your early deals, maybe kind of what it looked like, what some lessons gained. Sounds like the first one was relatively large, $7 million deal. That was the purchase price, correct? Not the equity?
Correct.
Yeah, still a large deal.
Yeah, we had to raise about 2.4 million to close that deal. The rest of it was a Freddie Mac small balance loan. And I partnered with 2 guys who had done multifamily before and out of state. And so they wanted to get into the Dallas market. I said, I would be boots on the ground. I would do all the work if they needed anything locally to be done that they couldn't do remotely. But they would be the brains. They have the strategy. They've done multifamily before. So I was ready to roll up my sleeves and kind of be an intern to them and see what help they needed. And that's how they took me on. And I learned a ton because we bought this deal back in 2019. It was 86 doors. It was in a tertiary market called Cleburne, which is about 30 miles west of Fort Worth. And COVID struck within a few months later. And so they could not travel as much. So I got to be literally the boots on the ground, visiting the property more, talking to vendors more, etc. So I learned a lot of asset management just by practice, but they were always there in terms of the leaders and doing the oversight and monitoring the financials and all of that. And when they could, they would also travel. So for me, it was the best learning experience. It was like, someone's holding your hand and you get to be a co-pilot before you try to pilot a plane yourself.
Yeah, it's like you have the headphones on, you're driving the plane, and they're directing you, from air traffic control. That's awesome.
Yeah.
So what was was it like a C-class value add play? I kind of read about that. That's kind of your core competency. Okay. Yeah. Tertiary to a very strong, larger market. Yeah. Do you remember the vintage of the property?
Yes, it was 1960s. It was an old 1960s flat roof, but individual HVAC, not chillers. Huh. Property, and it was in a cool place called Cleburne, which is sort of its own little isolated little place, like an island almost of itself. So nobody wants to move out of there. So even though we increased the rents and did a lot of renovations, etc., people wanted to stay put, and they were willing to pay the higher rents just to stay in that area. And there was a lot of signs of economic development there. There was a brand new $100 million high school less than a mile from our property that was just launching that August of 2019 when we acquired this property. There was a brand new huge sports center. There's a nice Cleburne State Park. You see things like Starbucks and Chick-fil-A. Those are, again, signs of, gentrification and growth in that area. So it had all the numbers in terms of economic growth and median household income, et cetera, to pay the rent. So that's why it made a really good sense. And so when people see the name Cleburne, they think it's somewhere in the middle of a boony town or something. So there weren't as many competitive offers on it back then as I would have expected. People didn't realize, 30 miles from Fort Worth is not too far. And so that's how actually my partners, because of their experience, got awarded the deal, and I just tagged along, which was great for me as a first deal because I was truly afraid to do something on my own, and that's exactly what I got. And we still have coaches, so even after we bought the deal, etc., if we ran into any problems, we could book coaching calls, etc. So those were some of the big benefits of being part of a larger mastermind program.
Oh, huge. It's almost like you can't even fathom doing that alone. As like your first deal, why would you go buy almost, 90 units, $7 million with a value add business plan? I mean, it would be reckless. But like you said, with your coaches, the mastermind, your partners, even the fundraising. You said you had to raise over $2 million.
Yeah, my partners did the most of that. I was a
Okay.
newbie and I leveraged their resume and I raised maybe 500,000 at best.
Okay,
But,
still respectable. What
yes.
if, on the capital raising side? I think that's a curiosity of a lot of the audience. You said you raised 500,000. Your partners picked up the 1.5 or the balance or so. What did you do that didn't work out or did work out? Do you have any lessons from like your first capital raise attempt?
So I was really afraid to even mention it, and I didn't have the confidence to discuss the terminology, etc., as freely. So what I did was when we were all together in large gatherings with the Sumrock group and outside as well, I always pulled them in. So we did the webinar together, and then I would have them with me when I was speaking to a potential investor so that they could answer the harder questions as I saw it. And again, it was a lack of confidence. I could have probably answered a lot of it. I was definitely the local market expert, but I didn't know enough about what's a value add play to speak with confidence about it. So when it got into the nitty gritty of the numbers, I would definitely pull them in at the beginning, and that really helped. So even now that I'm an experienced general partner, I take on new GPs with every deal. A lot of times they'll be like, okay, I have this guy and he really likes to dig into the numbers. I don't know what to tell him. I was like, let's do a Zoom call together. And so that's how I help newbies in terms of their confidence in raising money.
Yeah, and I kind of glossed over it earlier, but you made a really good point that I've personally learned and experienced. Doing these larger deals that, first of all, like you said, they have to really be done as a team. No one man or woman can go out there and get through contract, loan funding, equity funding, managing, dealing with like an 87 unit apartment. It's just can't be done. So by doing these deals that are larger, well, then you have the benefit of now you can go long. You can scale. I started small with no partners, and I literally, not quite in this order, but I literally did a single family, a duplex, a triplex, a quad, a 5, an 8, a 28, an 83, a big tract of land, a commercial building. So like it wasn't in that perfect order, but I literally was like just boom, 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 boom. And then eventually like the 28 and the 83 I partnered on, just straight partner, no, not a syndication. And my favorite deals and the most lucrative have been the large teamwork deals. The ones that like, I don't want to say ruined my life. I learned so much, but those little like starting with a flip, moving into a duplex, doing the quad, doing the 8, doing the like, those were grinding. I'm doing it all by myself. I might have even done some of the physical. I'm still in reasonably good shape. I'm just tempted to load up my Silverado and just go do work. And it's not the way to scale. It is not a good use of my time. And if you look at the hourly, it's abysmal. So I think that you were very wise to go with this model right out of the gates. I applaud you. And now, as in all candor, that's we're aligned that way. I might do, I call them little legacy plays where like I might buy something in my neighborhood in Jacksonville that I know I'm probably going to hold on to indefinitely. It won't be a lot to manage. And like I still pick up like a quad here and there. I do have some Airbnbs, but even those can be a bit of a distraction. I don't mind the cash flow, but some months they don't feel very passive. In other months, I'm happy I have them. But my point is, I think people listening to this need to be very careful early on about like the path they choose, because your active investor path, it's kind of like isolating. It's difficult. You might not feel like you have many resources. I mean, like Sandhya said, she was in a mastermind with coaches and partners. So you do this just on like a YouTube or listening to a few podcasts, you're going to feel pretty alone, when the rubber meets the road, versus going into maybe a larger asset, taking a small piece of a big deal and operating in like a team. So much can be gained, and it's very scalable. And look at, Sandy and I we're on a call, we're on a Riverside FM podcast right now, and a lot of people couldn't take the time to do this. We're able to sit and do these conversations and grow because we're passive investors. And I think that's what I know. Lots of people that are like mom and pop landlords that have no time. So I just wanted to point out that very significant difference early in your journey.
Yeah, freedom of time is huge. So you really have to think about your why. And once you decide that this is what you're going to do, you got to sort of, burn the boats, kind of, burn all the, boats, so that you have to stay in this island and figure things out. Otherwise, you're going to keep going back to that, whatever is your comfort zone, right? So like when I spent the huge amount of money that I did into this mastermind, it really propelled me into taking action. I was like, I've got to have a deal according to my accountant this year in which I can do active work. Otherwise, I can't qualify. I can't get any of the tax benefits. So when you have a, single-minded goal and vision like that, it'll propel you to go after it. So don't worry about how others are doing it, right? Do what works for you. And for me, that was the most important thing, is every day I would drop off my kids in school. So I had my daytime available, and that's what I had to offer. So if you think about what do you have to offer as a newbie to partners, figure out what is your best skill set and find partners who have a need for it. Like my two partners were out of state. So the knowledge of the Dallas area and being boots on the ground and willing to go on site, at a drop of a hat was a big advantage. So anytime they could tell me, can you go check on this? Can you go meet this vendor? He changed his schedule, whatever. I can show up. I can show up unexpectedly. So that's what I had to offer. So figure out what you have to offer, right? Maybe you're employed in the West Coast in California at a high-tech job or whatever. So you have access to a high network of investors, but maybe you don't have as much daytime available to you. So then offer to raise some capital from investors, right? So whatever is your strength, play that, and then find partners with complementary strengths who can complement your weakness so that you as a team are, combined and can do the best for your investors and your residents at these properties.
Obviously, everyone can tell listening to this, you're an excellent communicator, super driven, very impressive. What do you feel like your superpower is that you're able to go out there? I mean, 2019 is not that long ago, and you've got a great track record, great reputation. What do you think moved the needle for you? What do you think your superpower is?
I think the law of the first deal is a big one to remember. And for me, it was persistence. Like, I have no choice but to make this work because I have plunged this much money into this program. I better show some results. There is no other, alternative. Look, I've got kids. I've got to send them to college. I can't put this kind of college kind of money into something just to educate myself at my age without producing some results. So that drove me. So I chased after these experienced guys and told them, look, this is how I can help you. I know you two are a team and you two have worked very well together, but take me on. This is how I can help you, So, I had to persist. So you have to figure out a way to stay focused and persistent and not give up. And if I've had a lot of people say no to me, right? But one group said yes. These two guys said yes to me, and that's all that mattered, right? It's like you're applying for a job or you're applying for college, whatever it might be, right? All it takes is one yes to get that first deal going. And then you learn. Never stop learning wherever you are. Don't worry about the financial compensation quite as much on the first deal. Like I told him, I'll be your intern, put me to work. I don't care what you pay me. And it doesn't matter what splits and shares and this and that I get. I never discussed that. I said, just put me to work and pay me as you go, whatever you think is good. And, it was such a huge success, that deal, that in 27 months, we were able to more than triple our investors' money. So now I have a great first deal, right, that I can talk about endlessly because now I've actually done a lot of the physical asset management work, even though the brains were my partners, but I learned it. I learned what they did. I'm good with spreadsheets. So now I can just use that. And I have built what I call raving fans to come back as repeat investors. So this year in 2022, by October, I had already exceeded my goals. I only wanted to do 2 deals this year. I got 3 deals, over 600 doors, 75 million plus in, assets just acquired in 2022. And it's because you scale and you partner with other people. You can't do it all by yourself.
I'm clapping over here. I won't clap too loud. It'll hurt everybody driving their car right now listening. But no, that's amazing. That's a really, really cool story. I want to point out one thing that you were kind of quick about. You were not caught up on your personal splits and the personal benefit to you on that initial deal. And look how critical and awesome that was for you as now you have, I used to call them like a brag sheet, now you have a case study, you've got a full cycle deal, cradle to grave. And what's better than that? When you can go to an investor or a partner, even a bank, really every vendor in the industry that's either going to give you money or trust you and say, here's what I did, that's critical. I remember I was being mentored. This is brokerage, not investment, but there's a lot of overlap in commercial investment brokerage. I remember taking on deals for maybe not no commission, but so low, it was just going to cover my costs because I knew the building was going to be a lead magnet. If the owner was going to let me put some good signage up and I was going to have phone calls all day or emails all day or traffic to me all day, some of those, but most of those, let's be honest, 99% of those calls are not going to buy my building, but I can build a database. I can make new professional friends and relationships and figure out what they do want to buy. And some of those people also want to sell. And And if I was short-sighted and I just waited for someone to give me a full commission commercially, I might have sat around with my thumb in an undesirable location for a year and never closed anything. So I think you're very wise, because then once you get a deal under contract, you can talk about that. Then once the deal closes, you talk about it. Then it's operating, you're doing your value add, you talk about it. You refi or sell it, boom, you talk about it. Now you have a full cradle to grave deal, and then man, it's like sky's the limit.
Mm-hmm.
No, it's brilliant. I love it. So I wanted to kind of talk about, we're in a funny spot with, obviously we're recording this just before Christmas in 2022. A lot of things happening, rates moving quickly, multifamily trend, pricing hasn't moved all that much, but rates are high. So you kind of have this like frozen market of sorts, where it's like sellers aren't all facing the music. They're not feeling the pain yet. It's like they don't want to, it's kind of like not wanting to sell a bad stock. Like, I want to write it out. So, eventually you'll have some maturing debt and some motivated sellers. It's part of their business plan to get investor capital back. So, eventually people are going to need to sell. What's your, how has your game plan changed, or is it changing as we sit here on this interview today, and as you kind of look into next year? Or is it just business as usual, look at a lot of properties, write a lot of offers, fixed rate debt? Just talk me through kind of a little more high level coach's corner kind of stuff.
My general philosophy on deals itself is, because I know my Dallas market so well, once you may have, at one point, 100 deals in your emails inbox within a couple of weeks, but I can screen them by location, and they may only be 2 deals that interest me, just from location, vintage, and price per door. So I don't underwrite a whole lot of deals. And then when I ask for the whisper price, I already know the price per door that the seller is expecting that it'll trade at. And so right there, I know if there's even a potential. Can I come within $1 million or $1.5 million of that asking price, right? So then I don't spend a huge amount of time underwriting, as much as I look at the median household income, the crime stats, and all of that. So then let's say we have now found 2 potential deals. The process is still the same. You get a property management company to give you a budget, because they're the ones who are going to be running it. They're the ones who can realistically tell you, yeah, you can get $100 for that, or no, you can't get even $25 for that. So you need that analysis, right? You get a tax guy to give you the tax protest numbers. You get an insurance quote. You get your lender to give you a term sheet. So today that term sheet might say, hey, you're only getting 60% leverage and it's going to be 7% interest rate, versus a year ago it might have been 75% leverage at 4% interest rate. But it's still 2 numbers that you plug into your spreadsheet: your leverage, your loan amount, your interest rate, etc. That's still, numbers in a spreadsheet. So when you plug everything into a spreadsheet, it spits out and tell you, is this realistic or not, and getting the returns your investors want. And that's how you get a deal. So right now, I know enough to know that if the price per door in this zip code is this much, and this is the vintage of the property, okay, that's potentially a deal. So what am I going to do? I'm going to get out of this podcast and run up and go drive that property. That's the first thing I'm going to do, because I'm local. And once I drive the property, I drive that area, I go visit some comps, meaning the comparable properties of the same vintage within a 1-mile radius of my subject property, and verify that the amenities are comparable. Because even if the zip code and street address are similar, one might be way more fancy or offer better amenities and be able to charge something, versus your subject property might not. So I'll be doing that right now. If a broker sent me a deal that was so attractive, that's what I'm going to be doing. And then plug everything into the spreadsheet. I have a pretty good idea, because I'm already running and operating properties here. So I have a pretty good idea what my expenses would be for various things, whether that's my maintenance salaries or, my contract services, my marketing dollars, depending on the vintage of the property. So I can very quickly, in less than a day, decide whether or not I'm going to pursue an opportunity. So it's still the same. I just know what my loan is going to be. So if it's an assumption, yeah, I may have to plug that in. It might take me an extra 30 minutes to do that, but it depends on the loan terms and leverage. That's all it is.
And your local market expertise is so critical. Like you said, you're able to get to the property, and if you call, I didn't mean to talk about brokerage so much this episode, but whatever. Like if you call an agent or a broker, even if it's direct to seller, sometimes, like if you say, oh, I drove the property, I drove the comps. Here's my conclusions. Here's my assumptions. You don't have to be like aggressive about it. You can just say, look, here's what I saw. Tell me if you think I'm wrong, and talk through your assumptions. The fact that you went there, you photographed the subject, you photographed some of the comps, you looked at the amenities. It gives you so much more credibility. You are not someone that can just be ignored by a seller or a broker at that point by putting in some of that legwork. you
Yeah, and
know.
being in Dallas, there's a few major brokerages. Like you definitely want to know a broker in every one of them. And I've purchased or sold through, four of them already. So I kind of now have a reputation, and so brokers take me seriously if I say I want a property or I want to make an offer, etc. So that's not been as much of a challenge now as it was at the beginning 3 years ago.
It's interesting because, like I said, I started in the appraisal side, and I did a lot of hotel appraisal, but we did a fair amount of multifamily.
Mhm.
I never knew I was going to eventually invest in the asset class, 10 years later or whatever. But I feel like appraisers and of course this kind of goes with lenders because lenders and appraisers, the underwriting so like hand in glove, but
Mhm.
they get really caught up on rent per square foot of unit. And I feel like in the marketplace, like as you look at a consumer, I was thinking about it as you said this, the access, the grounds, the feel, like the configuration. Because 1,000 square feet can be configured a lot of different ways.
Mhm.
Is it an open kitchen? Is it a galley? Is it small bedrooms? Are there good closets? What are the amenities? How about ingress and egress? Is it like horrible getting in and out of this thing?
Mhm.
Is it quiet? Is it loud? So I do think that I'm a fan of your style of like going straight to the asset because that's kind of what I came up with is as an appraiser, I had a sheet, I had an interview sheet and I had stuff for like the physical property. I didn't really do a whole lot until I went out there. Like I pulled like maps and tax cards and property record cards and aerials if I could. So I knew like year and unit count and stuff like that. But I wanted to get out there and put my eyes on it because so much is instantly revealed the minute you get there. And if you take the time to drive the competitive set like you're talking about, whether it's the for sale, I'm sorry, sales comps like listed or closed sales, and of course the ones that are not in the market and haven't sold, but they're just your competitive rental comps, that can tell you so much. You'll be able to really dial in your assumptions. Stuff that you could easily blow from a desk, states away, just thinking about price per square foot, rental price per square foot per unit. So I see. All I'm saying is I see how you're having a good track record by knowing your market, driving the assets, driving the comps.
The biggest thing I look for is that the rents at the subject property are far below the comps in that market so that I don't have to do a whole lot to get a $50 or $75 rent bump per door. The other thing
Mm-hmm.
I would watch out for in 2023 with respect to underwriting is, your smaller units, really look closely at the square footage and look at the ratio of one bedrooms or studios versus your twos and threes, because I see more and more families, especially in your C and B class, moving back in with their parents or something to reduce their expenses. So you're going to find twos and threes more popular than studios and ones, depending on your location and who your basic client is. Versus, if you're an A-class property located in a fancy part of downtown with all these, white collar jobs, a lot of single guys would like to have an apartment to themselves. So you kind of got to look at that and say, who's my avatar, who's my client in these apartments, and what kind of amenities, apartments, unit sizes, etc., that they would like. Some of them like the private fenced yards, which was one of the value add things we did at this property in Cleburne, and we got like a $50 rent bump just from adding private yards, because one side of the property was townhomes and the other side was your typical garden style two-story apartments.
Mm-hmm.
And so another value add we did there was the leasing office was housed in one of the largest units, a two-story, two-bedroom, 1.5 bath condo. And so we moved it out of there. We partitioned the laundry center, which was quite large. We made half of that the leasing office and built an area there. So now we got a whole new unit added for which we could get the rent. So that's a direct impact to the NOI. And then we did interior upgrades. This was classic units. Nothing had been touched since, back in the 60s. So it was very easy to go in and add new appliances, a fresh coat of paint, a clean white subway tile backsplash, And again, we only did the amenities to the extent that it would get us the rent bump. It's not like, let's go put $10,000 and everything. If the flooring was fine, let's just do paint and let's just make the kitchen a little bit attractive looking, and let's leave it at that and see if we can get our rent bump.
Yeah.
And so that was something. And then we also, this property was all bills paid. So while everybody's thinking about revenue, if you can reduce your expenses, that's also going to impact your NOI or net operating income. So we did that by doing water conservation. These had the really large 3-4 gallon kind of toilets, and we installed the 0.8 gallon flush toilets, and that saved a lot in the water bills. And then we also did an LED upgrade of all the lighting in the property, because again, we were all bills paid. So all these energy savings translated to a direct impact to our NOI. So when you impact the NOI, and we ended up selling it at like a 5 cap, below 5 cap, So we made a killing on that property. We ended up selling it for over $12 million. And
Nice.
so, when you think of 7 million and selling it for like it was actually closer to 12.4 million, your 2.4 million is already returned in that first 7 million, and you have over a 5 million difference. So that's more than again double. So you end up tripling your investors' money. So 100K was returned as, 300K back to the investors.
Beautiful. Yeah. On the all bills paid, I think that's, I'm not saying they don't exist throughout the nation, but it's not like a super common structure. Like hospitality properties and things like that, are often all bills paid. Some like student housing is all bills paid and stuff. But so they weren't even individually metered. You just needed to. Oh, I'm not trying to put words in your mouth. The property, tell me, was it individually metered, or you just had to go out there and drive your expenses down because it was all on one water meter? And was it individually metered for electric or not?
It was because they had switched it to individual HVAC, and so
Okay.
we could have done individual metering on electricity, but it was already an all bills paid property, and so keeping it that way is what the tenants were used to. So we just looked at how can we do the expense reduction by
Yeah.
doing those two things.
Interesting. Yeah, actually, I'm trying to think of an apartment, like a traditional C class apartment, non-subsidy, and so
Mhm.
to have the utilities paid by the landlord. Yeah, yeah. I can't think of one here in Jacksonville, but no, I totally understand. I mean, if my analogous thought on this is like if we had a hotel, we're eating all the expenses, we want to drive our revenue. Yeah,
Mhm.
bring down the water in the toilet, LED everything, like conserve, 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 and it all drops to the bottom line. So I totally get it. Okay.
Yeah, a lot of residents really like to know what their billing is going to be, and that it's not going to fluctuate from the hot summers of Texas in August versus the winters in Feb. So they like
Hmm.
to know that it's a constant amount that they have to budget for. And so 3 of my 6 properties right now are all bills paid, and we're keeping them that way.
Wow, half your portfolio.
Mhm.
All right. Well, I won't dwell on that. I don't see it a lot, but it sounds like something you're thriving in. And I think that actually does bring out, kind of a coaching point right there is, if you find a niche where you're excelling, like I said, I'm sitting on the other side of the microphone. I haven't really done an all bills paid multifamily deal, and you're excelling in it. I
Mhm.
remember, I'm sure most people listening to this probably have also heard Brandon Turner talk. And, there's people that apparently do really well with these like septic lagoon mobile home parks. And it sounds disgusting. But then, like, some investors won't touch them. And
Yep.
I actually haven't put my eyes on a septic lagoon. I'm not sure if I really need to, but sounds horrible. But some investors are like, oh, I know nobody wants to touch septic lagoons. I'm gonna go out there and I'm gonna clean up metaphorically, financially on these
Mhm.
septic lagoon mobile home parks. So the point is like finding a niche and really excelling in it, going deep, getting vertical. It's really rewarded. In Jacksonville, our housing authority for like HUD and Section 8 tenants, they historically have been challenging to work with as a landlord. Um, but I got into a groove where my property manager had really good relationships with like the local inspectors. We were getting things approved in between inspections really fast. And I got to where I actually liked the voucher tenants. It was never the tenant. Usually the voucher tenant was fine. It was the bureaucracy and the paperwork and the red tape working with the housing authority. Once you got it done, it was a direct deposit payment, like an ACH transfer every month. I loved it. But again, it was something that like most of my landlord friends, they'd kind of run from. And then once you kind of cracked the code and spent the time and built the relationships, it was wonderful. So anyways, I think it's important to hone your niche.
Mhm.
All right. Well, I like to do what I call this. I know you actually just kind of ran us through that deal, and if that was the deal you wanted to run through, that's fine. I do like a coach's corner kind of deal breakdown. Is there another cradle to grave deal, or do you want to stick with that one?
That's a good one we can go in more depth
Yeah,
on that.
yeah. I think that was a good one too. You gave us the numbers too. Oh, I was going to ask you, did you when you put that out for investment, do you remember what you were marketing to your investors as far as like pref or return? It sounds like you exceeded whatever you offered them. So I
Yeah.
was just curious. Yeah.
We have not done a pref return at all to our investors. We
Okay.
just do a straight split, and it's a pretty flat 80/20 is the split we like to do in most deals. And it's a matter of, okay, if the deal makes money, you get a distribution. I also get a distribution as the general partner. If the deal makes no money, nobody gets any, nobody makes money. And then the other thing we do is if the deal does very poorly, which it didn't, we don't take an asset management fee till the deal actually performs. So those are some of my guiding principles when I make
Yeah.
an investment out to investors. But we just taking a flat split makes it so easy. There's not different classes of investors. It was as simple as it gets. You could do it at the back of a napkin. And we actually only projected a 5-year return of 70% in 5 years. But we also projected a very large exit cap of 7.2. So we had like, a full 2 basis points above our purchase cap when we did that. And of course, cap rates were crazy in 2021. Everything compressed, everything stayed compressed. So that helped with half the returns that we got. But the other half was actually being able to boost that NOI, right? With all these strategies, like a new leasing office, right? Which was, gave us a completely new, brand new extra unit to add to the total unit count. And then the private fenced yards, energy conservation, and then interior upgrades.
I like your point about, straight 80/20, and yeah, maybe there's some fees coming in, some fees going out in asset management, but that's fairly common. Like when I talk to friends of mine that have, no knowledge of what I do, no knowledge of real estate investing, certainly never heard of like the term syndication. If you say pref or like, preferred return or waterfall, I mean, you can they're trying not to show it because, a grown 40-year-old or my friend, they don't want to look silly, but I can tell I am losing them. And when you go to, and I'm not saying I couldn't explain it more, and that, and some people are professional investors and that's just, they get it, but I think to your point, having a simple, when you talk about splitting what's left, okay, income, expense, debt service, maybe some reserves, what is left? And then that's what we're going to distribute. You're going to get 80, we get 20 or whatever it is. And I think there's some wisdom in making your waterfall, see, I used a complicated word, and using your distribution nice and easy. And so I applaud you for that. We had a guest on here. He goes by Captain Key. And Key's a guy out of, I think, California, and he does 80/20s. It's funny. So now you're the second person. And his rationale too was he likes to have like one big investor sometimes maybe two, but he's like, it's so simple. He's like, I go to like one or two people. They're high net worth individuals. I think they sold some companies or bought Bitcoin for $1 or who knows what. But and they're like, just keep it simple, 80/20. And like, I think it's just like you said, if things get tight for any reason, waive the asset management fee and stuff like that. So no, I applaud you for keeping it really straightforward. I'm sure it helps with capital raising.
Yeah. No, we've never had a waterfall split. We've never said, oh, if we make this much money, you only get half and I get the rest. We've never done that. It's always been 80/20, which is why my investors made so much money in that deal, is because, hey, just because the cap rate's compressed, it's not like we did something extraordinary. Half of that credit should go to cap rate compression. So you get to come and participate in the upside just like me. I'm not going to take any more or cap you at, you can only make double the money. No, you can make as much as we make, and everything is profits. It's all 80/20. Yeah. And so that's why we have investors coming back, because we've kept our structure very simple. Even the most recent deal I closed in October, 80/20, straight split. That's it.
Yeah, I like it. I mean, and like the deal you said, they got their money back, and then they got 80% of over $5 million. So that's, and what'd you say, 27 months or something?
Yes, 27 months, August 2019 to November 2021.
Beautiful.
Yeah, with the bulk of the hold period being through COVID. That's what people need to realize is, the world shuts down. Everything gets closed. Everybody's sitting in their homes, racking up those electricity bills and everything. And here I am through COVID, which was the bulk of the hold period of this deal. And we did so well. So remember that about real estate. If you're 100% into the stock market, which is what I used to be, I've done 25 years of investing in the stock market and I still put money there. You have so little control, so there could be a Ukraine war, some policy change. And, even if the company performs well, your stock price could go down because it didn't meet an analyst's expectations. So diversify. If you keep going into different sectors, but it's all still in the stock market, that's not diversification.
Well, Sandhya, you have like an infectious energy about you. You have it's really it's fun. So I mean, I always state up. I want to be an enthusiastic host, but it's easy with you. It's like it's just I just want to go run through some walls with you or do a deal with you. It's great. But what is that? What have been some of like your biggest influences? I don't always ask that question, but I'm curious. Like, how'd you come to be this way? Such a driving force.
So. It's actually the good old 80s and Top Gun, the movie. So literally like sitting in India, I was so fascinated by America, the culture, the music, the movies, everything. I wanted to come here, except my parents made about $50 a month in income. And I wanted to come to college here for tens of thousands of dollars. And the only way that was going to be possible is with a scholarship, right? So right then and there, it was sort of like, how badly do I want it? And if I want it badly enough, what am I willing to do for it, right? What are you willing to give up to focus on that one goal? And so that's where I would say is, focus on your goal and don't listen to any naysayers, and surround yourself with people who will help you get to that goal. Because I just looked at it and said, oh, I really want to go to America. How do I go there? And then we were like, okay, there were some examples. There was somebody in the same town I lived in who went to America. I'm like, how did he do that? I know his parents are not that rich. So it's just, look around to see who's doing what you want to be doing, because success leaves clues, and only follow them. Don't take advice from a financial planner who only looks at mutual funds all day and ask them, should I invest in real estate? Because they're going to tell you, oh, no, stick to my mutual fund for which I get a commission, right? So yeah. It's just as an example. But in terms of books, Atomic Habits is a great book because it teaches you the incremental power of making one small positive change every day. And don't forget, one small negative change every day also can add up. So, be aware of that. And then I like the 12-week year as a concept, because all of us think, oh, it's December, the year is over. And then you start out and then you think you have a whole 12 months, which really is more like 10 and a half months. So instead, set goals and say, on a quarterly basis, where did I go? That's it. Mm-hmm. Your year ends in 12 weeks. What are you going to do about it? And
I like that.
You have a shorter focus, shorter term for accomplishing something. It's like, I want to raise $1 million. Well, how are you going to do that? That's maybe 20 investors at $50K each. How do I get one investor? Okay, what am I doing on a weekly basis to get to that $1 million, right? Mm-hmm. Have a way to track your progress and set a deadline. So same with multifamily or real estate investing. If you decide I want to invest in multifamily or I don't, so write out your list of 20 questions, get them answered by a deadline. Otherwise, you will drift, and a year from today, you'll still be in the same spot wondering, should I invest in real estate? And instead, if you get your 20 questions answered in the next 30 days, you're all set to make an informed decision.
I like that a lot. And I've been on an Audible kick. So especially with like personal development or business books, a lot of them are pretty easy to take in on mm-hmm. Audible. Like I did Rob Beardsley's underwriting book, and I needed to like read that. It's different. But for a lot of the personal development stuff, Atomic Habits was one that I finished maybe like 6 weeks ago. Love that one. And God, it's just so good for no matter what you're doing. It just like makes you a better person. And mm-hmm. my wife listens to most of these episodes, even though she's a public defender, does nothing with real estate or investments. And she would laugh. But after I finished Atomic Habits, you remember that chapter on like habit stacking? You just essentially mm-hmm. bolt something onto a habit you already have. So as of this recording, I'm still doing it. I'm proud to say I brush my teeth twice a day. And what I do is, because I'm going to brush my teeth twice a day, I'll drop down after I brush my teeth and do a set of push-ups. And it's like, I just finished the book. And I was like, I want to stack something onto something that I'm never going to not do. And my whole life I've brushed my teeth. So I was like, I'm going to habit stack something off of teeth brushing or tooth brushing. And so I will say for like almost 2 months now, I can't always get the reps that I want, but I will drop down and do some push-ups every time I brush my teeth. So I know that's a silly anecdote, but that Atomic Habits book, man, there's so many good takeaways, so many good ones.
Like I love to watch the Dallas Cowboys, but I said I have the luxury of sitting in my couch and watching a game. If I'm working or if I'm sorting something that I have postponed sorting, like, that one messy drawer, or every time there's a commercial break, I've got to do some intense exercise, like your push-ups, sit-ups, that level, not just walk and take a few paces for a bathroom break or grab a beer kind of break. No, you actually have to.
I take too many of those.
So I'm just like, that's my reward and, work kind of system. I get the luxury of watching a game if I'm also productive in some way.
Now, when you're not out there, crushing your your professional goals, what are you doing for fun? What are your personal hobbies?
We love to travel, and I said, I love watching football, NFL. This is my most favorite season of the year. I watch a lot of NFL, and so when I watch it, I have to, again, be productive. But I love to travel. Travel is one of our favorite hobbies. So I'm always looking for bargain fares, because I took my family round trip for 4 of us to Iceland for free, and I was able to get a pretty good discounted rate for a hotel. So finding deals is a big deal for me. But we fly coach class. We don't care where we sit. We don't mind the inconvenience of waiting a few extra hours and volunteering our seats so that the airline will give us free tickets. So we'll do all of that. But that's awesome. How I go. I take my family. So we're not into all the luxury living. We're more into, hey, what can I go do for, free? Can I go sample all the free foods at Sam's before I buy it? Yeah.
No, you're great. I love this. Yeah. Humble beginnings. Yes. And you said, you came over here. How do you get that scholarship? Get into the school, go, go, go. You're like, yeah, you don't take anything for granted. No, you're a lot of fun. I look forward to meeting you in person one day.
Sounds good. Kentucky, right? For Race Fest.
Yeah, see you at Race Fest, January, Kentucky, January 23. So by the time this airs, it'll be right around the corner. I'm loving it.
Yeah.
All right. Well, lastly, where can people find you?
My website or LinkedIn. My website is engineered-capital.com. So engineeredcapital.com is my website, and I'm on LinkedIn, and I'm also on Facebook. And of course, the best way to get a hold of me is through Ian. So reach out to Ian, and he'll tell you how to find me.
Wonderful. Yes, I will get you right to Sandhya, and I think you're going to learn a lot from her. I'm tempted to jump into one of your deals. You're doing so well over there in Texas. We Florida boys get jealous sometimes. Everybody's going to Texas. All right. Okay, well, guys, I think this has been a great episode. If you enjoyed my interview with Sandhya, I want you to jump on whatever you're listening to and subscribe and rate it. If you're watching this on YouTube, like some people do, go ahead and drop some comments in there. I love the feedback. It helps me decide what we're going to do next as we go into season 2 of the show. All right, guys, we put out content on Instagram, Facebook, YouTube, everywhere we can, bring you updates and other investment opportunities. So always stay tuned. But this show is a wrap. So for now, this is Coach Brown signing off and reminding everyone to lace up and leave it all on the field. Yield Coach out.